What happens when a market that has never been allowed to discover its true price is finally forced to do so? That question now hangs over gold and silver as the structures that controlled them for decades begin to strain. According to Sheckman, this moment has little to do with technical signals or speculative enthusiasm. It is about a paper-based pricing system colliding with physical reality. For years, price was shaped by leverage and confidence that contracts would be rolled forward rather than settled. That assumption is weakening, and once it does, the framework that governed these markets starts to fracture. The defining feature of the current move, Sheckman argues, is not excitement, but pressure. Gold and silver are advancing because delivery demand is overwhelming paper suppression, not because the public is rushing in. Retail participation remains limited, and skepticism is still widespread. Many assume prices are stretched or that a correction will restore normal behavior. But when physical demand begins to dominate settlement, price action changes character. It stops moving in measured steps and starts repricing in abrupt adjustments. What makes this phase so easy to misread is that it lacks drama on the surface. There are no widespread shortages at the retail level, no mass panic, no sense of urgency among the public. Yet beneath that calm, stress is building inside the system itself, in rising margin requirements, in clearing mechanisms under strain, and in shrinking availability of deliverable metal. Attempts to slow the advance through higher costs and forced liquidations are no longer achieving the control they once did, because the entities absorbing supply are not dependent on leverage or short-term positioning. In Sheckman's view, the deeper implication is that gold and silver are no longer acting as simple commodities. They are responding to a broader erosion of trust in financial structures. This is not a trade based on inflation headlines or growth forecasts, but a reflection of confidence being withdrawn from paper claims. In this video, we'll break down the forces reshaping the gold and silver markets, from supply chain pressure to institutional behavior. If you value analysis that looks beyond price and into structure, be sure to like the video, subscribe to the channel, and stay with us for the full discussion.
I think that's not true. I think that short-term caution should always be employed in a market that's moved up this fast. Long-term bullishness can coexist with that. And again, what I think even people like Ross, who far be it from me to argue with a man who's had serial success like him, but I believe this is different. This is not technical analysis. This is not what used to be. The dollar isn't trusted anymore, nor are institutions, nor is the system trusted. And I think gold and silver are reflecting that through delivery. The biggest, most well-informed players in the world continue to stand for delivery at a level no one has ever seen. And the retail public wouldn't know a gold coin if it fell on their foot. So no, this is far from a bubble. If this room was filled with people that have never been to a place like this ever, then I might agree with that. But the retail public has no idea yet. I mean, there's more people here for sure.
Yeah.
But this isn't mainstream, dude. I mean, I've been doing this for so long, and I live in a country club of very well-heeled people, and maybe 5 or 6 of them have bought gold and silver from me. I don't talk about it. They know what I do. But there are very, very, very successful, wealthy people that are just who believe what Ross is, that this is oversold or overbought rather. This is a bubble. Look at the technicals, and I would say none of that matters in an environment that was once manipulated and is now trying to break free from that, because the most well-informed traders in the world disagree, and I think that's the public hasn't caught on yet. So no, I think we're a long ways away. But a correction, sure, doesn't change my long-term bullishness view. You know, on the highest level in December, we saw 65 million ounces or so delivered off the COMEX or onto the COMEX. Who's buying that? A mint box of Silver Eagles is 500 ounces, weighs 42 pounds. Who's buying 65 million ounces? But it's been between 40 and 60 plus million ounces every darn month for the last 15, 16 months. Who's doing that? And you look at the LBMA, David Jensen, one of the best that there is, he says that London has 2 billion ounces in outstanding spot contracts that have standing behind it 140 million ounces. What could possibly go wrong if everyone stands for delivery? 2 billion into a window of 140 million. That's a problem. But when you look at what's happening here in the United States on a retail market, it's very, very, very confusing market. Largely because the price is moving up so fast the cost of maintaining positions is moving up so fast. Let me put it this way. We hedge every ounce we have. We will typically have between 2 and 3 million ounces of silver in our warehouse. To hedge one 5,000 ounce silver COMEX contract, you need to have over $40,000 in your margin account. On Christmas Day, it was 21,000. And so not only are the margin rates going higher, which shakes the weak hands off the tree. Let's look at December. They raised it twice in 2 weeks, before and after Christmas. So the day Christmas, 21,000, the next day 27,000 in your margin account. Now it's over 40. But if you are someone with a bunch of money in your margin account and you have a bunch of contracts, you're trying to take advantage of this silver run, and all of a sudden they raise the margins on you by 30% on the day after Christmas, and if you don't pay, we liquidate. Well, a lot of people are forced to liquidate to cover their margin on the other contracts or whatnot, which selling begets selling begets selling. Now in 2011, that killed the rally. That's what they did to stop the rally. They raised margin a bunch. This time, what happens? Oh, it's the largest delivery in the history of the COMEX for the December contract, because the people that are standing for delivery, they don't use margin. They don't care. It's a subsidy to them. Thank you very much, they say. Scoop it up and stand for delivery. So things are changing, but I will tell you, like refineries, they're not taking any business right now because it's taking them so long to purify and produce. And they have to hedge their position too. So if they have 30 million in work, it takes weeks to get it fully produced from scrap or junk silver or doré or whatever to the refined product. It takes a while, but the price is moving up so fast that their hedge book, so if you have 30 million, you have to sell 30 million on COMEX. So if the price of your 30 million in inventory drops by, $10, you're not out enough to put you out of business. So instead, you short the exact same amount. You remain market neutral. Problem is, silver's moving up so fast and the rate hikes are moving up that they're getting margin called. So the refiners aren't taking anything. The big companies like myself and even the bigger ones who try to hedge, if you have 3 million ounces and it costs $41,000 to hedge 5,000 ounces, you have to have millions and millions and millions of dollars in your margin account just to maintain a hedge position. It's a crazy environment right now. Kai, I've never seen anything like it, but to me, all I look at is the most well-informed traders. Since I started talking with you, it was the central banks, and now it's progressed to whoever the hell is doing it here in the United States at a level no one's ever seen before.
This is exactly what the markets aren't telling you. The gold and silver landscape is quietly transforming at a scale most people fail to see. Andy Sheckman highlights that even top-level financial advisors and accountants have no clue what's coming. Some wouldn't recognize a gold coin if it hit them in the foot. Yet, at the very top, institutions are already moving massive allocations into gold, selling portions of bonds, and positioning themselves well ahead of the public. The first-mover advantage is enormous, and ordinary investors are still sitting on the sidelines, unaware that the game has fundamentally changed. Sheckman stresses that $5,000 gold and $100 silver are not just price targets. They represent a seismic shift in economic mechanics. At these levels, governments can push revaluation schemes, peg bonds to gold, and incentivize domestic manufacturing in ways previously unthinkable. Programs like zero-coupon bonds tied to gold and the Genius Act are designed to reshape borrowing, reduce upfront costs, and create an entirely new framework for wealth and production. Rising gold doesn't simply protect wealth. It actively reshapes the monetary system, challenging assumptions about the dollar and debt. The global picture amplifies this trend. China, along with the BRICS nations, is constructing an alternative ecosystem for gold settlement outside the US dollar system. Through digital yuan convertible into gold, multi-jurisdictional vaults, and platforms like Bridge, global trade is increasingly bypassing traditional dollar channels. Countries are securing their own monetary sovereignty, and Sheckman warns that this is quietly eroding the dollar's dominance. Investors ignoring these shifts are at risk, while those who understand the strategy are quietly taking positions that could yield enormous gains.
I would always say be careful what you wish for. But really, to me, what it is, instead of the world burning, it's the dollar bills that we call money are burning. The paper currencies have the sustaining power of a melting ice cube. And so did gold and silver really go higher, or did the dollar that we call money really fall further? And I think that's what it is. When you're creating $1 trillion in debt every 100 days, and 1 trillion seconds ago was 31,688 years ago, when the world no longer trusts dollars, no longer trusts treasuries, no longer trusts our institutions, judicial system, electoral system, immigration system, all of these systems, then what is the incentive to hold treasuries and or to hold dollars? There's not. And that's why we're seeing de-dollarization. That's why we're seeing commodities usurping treasuries. That's why we're seeing the dollar lose purchasing power. The world is always burning somewhere, but not to the way that people would frame it at $5,000 gold or $100 silver.
So is this really anti-dollar positioning that we're seeing, or is there more to it? It feels like it's difficult to boil it down to one point. Right?
I think at the highest level it is. It is anti-dollar system. It is the realization that money is gold and silver and everything else is just credit, as J.P. Morgan said. But yes, I think to a large degree it is at the highest level. You know, there's a whole school of, to Ross Beatty's point, the counter to it. There's a whole school of investment theory called wave theory, right? Kondraty of Elliott wave, which is about the masses. The people here are the pimple on the elephant's ass. This is not the masses. The masses are out there. And Kondraty of an Elliott wave says it measures the emotions of the public, the herd, from, greed, which turns into exuberance, irrational exuberance, fear, panic. We're long ways away from the fear side of it with pouring into metals with the public. We're a long way from that top on the retail level. They haven't even really started to run through the door yet. So up there, they see it, they're pre-positioning, but I don't think we're anywhere near that blow-off top because the public is really not participating. Goldman Sachs is that we've been saying this forever, and they keep changing. It's like a moving target. Yeah, 2,000, no 2,400, no 3,000, no 3,100, no, and they keep going higher and higher and higher. At some point, it would just be nice if they said we were wrong. And they have been wrong. And you look at the S&P 500 up under 20% in the midst of the greatest tech boom ever last year. Silver up 150, 7 times it. Gold up almost 80, 4 times it. Where are the advisors who said, don't buy that stuff, it pays no interest? Where are they with the tail between their legs saying, I don't know, you live in Germany. I don't know if you remember Happy Days, the TV show. You remember that?
No, I don't.
There was a TV show, and for your older viewers, they'll remember it. And there was a guy called the Fonz, and he was this leather jacket, motorcycle. He was super cool, and he could never say I was wrong. He would say I was ruh-ruh-ruh, I was ruh-ruh. They can't say the ruh-ruh, they can't say they were wrong. And they have been. And the people who have separated themselves from the masses have been right. And this is why I think we all need to trust our gut and our intuition, because we're in uncharted waters, and that speaks, I think, far more clearly than a financial advisor who might have different interests or objectives than you, and maybe has been married to a school of ideology that stocks and mutual funds and bonds are the road to retirement, so they learn more and more about less and less till they know everything about nothing. But what do you know? The CIO, Chief Investment Officer of Morgan Stanley, what did he say? Well, that 60-40 stock bond platform that we've used for 50 years, it's broken. Sell half your bonds and put it into gold. So here at the highest level, which hasn't filtered down, I have an account at Morgan Stanley, and the broker is a good buddy of mine. He wouldn't know gold coin if it fell on his foot. I said, do you know your Chief Investment Officer said sell half your bonds and put half of it into gold? And he said, no. But this is coming from the CIO. It's starting at the top, and the big money who positions before the plebes, they'll get it, but long after the big money's already sitting comfortably in their deck chair.
Absolutely.
Well, I'm giving a talk here this week, tomorrow, about gold going higher than anyone thinks possible, because the goal of this administration is to shed the reserve currency. As crazy as that sounds, the term Triffin's dilemma says you will never have a positive trade surplus if you're the reserve currency. Vice President Vance has talked about it. The knucklehead, Jared Bernstein, one of the goofiest guys I've ever seen in my life, trying to explain how treasuries are created. He was the chief economist for the Biden administration, he did write a report called Dethrone King Dollar, which advocates for losing the reserve status. And there are mechanisms like the Genius Act, which says by January 1st of next year, anytime money moves, it will move via stablecoin. And the stablecoin has to be pegged to Treasury's 90-day maturity or less. The Clarity Act says that, well, that interest is not transferable to me or you, the holder of the stablecoin. The issuer keeps it. USA Tether, their CEO is a man named Bo Hines. That was Trump's crypto czar through August. What has Tether been doing with all of that interest? They have $14 billion in gold right now, which is the largest stockpile in the world outside of central banks. And what does rising gold do? Devalues the dollar. And if Judy Shelton, who was on my show twice, is right, she said Trump told her July 4th of this year, which is the 250th anniversary of the country, he'll peg the back end of the bond market to gold. This is how you bring back manufacturing at zero upfront borrowing costs because you have to pay it in gold down the road, zero coupon bonds. So you have the Genius Act on the front end of the curve. The interest goes into gold, which pushes the price of gold up, depresses the dollar. And if Bo Hines is the CEO, do you think there was a wink, wink, nod, nod that said that gold that you guys are buying is going to be purchased by the U.S. Treasury? If they then back the back end of the bond market, you talk of revaluation. James Rickard says 24,000. What if it goes a whole hell of a lot higher? Van Eck funds just came out and said if the dollar loses its reserve status, meaning the Treasury to me more than anything, and gold replaces it, they see gold going to $180,000. That's Van Eck. So imagine you sell a 20-year bond redeemable in $100 million in gold today at $5,000 an ounce. That's a lot of gold, right? 20,000 ounces or whatever. How about at $180,000? Now in 20 years, bang, you just ended up giving 300 times less than you did today. So not only does the dollar get massively devalued, but you can now bring back manufacturing at zero upfront borrowing costs and sell your products at a wickedly devalued dollar. That's what the whole world has done to us. That's how they sold us their goods. The dollar's been stronger than anything. And Triffin's dilemma, in essence, says that the world needs more dollars than we can give them through trade alone. So they end up selling their currency to buy ours. Our dollar goes up against theirs. And so we will always have a trade imbalance no matter what. So the moral of the story is, Kai, I think we are entering into a new monetary system where gold is replacing, in many respects, the Treasury. And that's why I don't think we're in the bubble. I think we are in a new monetary system. And to use old school technical analysis or anything you want to look at that has worked in the past, I don't think it works anymore. And that's what you have to wake up and realize. At least that's what I believe.
So you think down the road the U.S. is weaponizing gold?
I don't think weaponizing is the right word. I think the U.S. is letting gold letting gold go higher and incentivizing it to go higher, to peg it to the bond market, to reshore manufacturing. Look, Ray Dalio just came out and said 60% of the country has a reading proficiency under that of the 6th grade. We're $200 trillion in debt when you add in Medicare, Medicaid, Social Security, government military pensions. We don't make anything, so we're broke, we're insolvent, we're uneducated, we don't make anything.
Could we be on the verge of the most dramatic shift in gold and silver the markets have ever seen? The signs are all there. Delivery numbers are smashing previous records. Physical demand is overwhelming supply, and the traditional controls that once kept prices suppressed are losing their grip. Over the next 12 to 18 months, it's likely we will see gold push towards $7,500, while silver could surge toward $200 per ounce. This isn't a guess. It's a consequence of systemic pressures finally coming to the surface. The next move won't be slow or quiet, with margin requirements skyrocketing and the biggest players quietly stacking physical metal. The paper market is being forced into positions it cannot sustain. Every ounce taken off exchanges, every contract stood for delivery, is accelerating a tipping point that could trigger a rapid repricing of metals. Retail hasn't even started to participate meaningfully, meaning the real squeeze may still be ahead. This is more than a bull market. It's a structural realignment. As the dollar continues to lose credibility and institutions scramble to secure tangible assets, gold and silver are poised to dominate as the true measure of value. When this next wave hits, the corrections and fluctuations will be sharp, but the long-term trajectory points relentlessly higher. So the question everyone should be asking is, are you positioned for a world where the old rules no longer apply? when gold climbs to $7,500 and silver to $200. It will rewrite the entire investment landscape. Those who hesitate now risk being caught on the wrong side of a historic surge. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.